Hi, I'm Kane Barano from HWP. Today I'm joined with Managing Partner Will Hamilton, who's recently returned from Europe. And today we're going to explore some of the key insights that he's found and some of the experiences he's had whilst he was over there. So Will, at the conference you attended, you mentioned that Australia was only briefly referenced. Why do you think Australia's presence was so limited, and what implications might this have for local managers?
Yeah, I think that, look, we are only 2% of the world, Kane, and thanks for asking the question. I think the other thing is, if you look at the outlook for Australia, and, you know, as capital economics are showing, you've got probably nearly 10% upside next year and the year after in the US market, and they're looking at flatlining on the growth expectations in Australia. And so it's the composition of the index. I think we've all seen over the last year one stock in particular, being CBA, really power away and drive a lot of that stock market performance. So I think it's a small market. It's also, I think, as far as a few people have considered, that there's few opportunities. I think that's the reality of it.
Okay. And in your notes, you expressed caution when some of the speakers used the phrase, "this time it's different," in regards to geopolitics.
Yeah.
You know, what makes you so sceptical of that phrase, and how do you personally interpret it with respect to geopolitical risk?
Look, I've been in markets for over 40 years, and I've heard many times that term, "this time it's different," and it's sort of a dangerous term to use. But I think on geopolitics, the fact is there is a lot of activity out there, and I think that's why people were talking about it. Yeah, conflict in the Middle East. We've seen conflict in Europe, conflict in between India and Pakistan, and recently Thailand and Cambodia. There's a lot of conflict in the world at the moment, and then you've got the US president and what he's doing, and this is going to have at least a lasting effect of 4 years. So I think you all know, and a lot of our clients know, we've built scenario analysis into things. That's what you've got to take into account. And so for a couple of years now, our clients have very much got used to seeing our 4 scenarios that we build out. And it's not about saying this will happen. It's about looking at what could happen, and therefore how we adjust and approach asset allocation on the back of that.
Yeah, very difficult with so much uncertainty. Yeah. Another key takeaway was the shift towards private markets and infrastructure investments. From your perspective, what are the most compelling reasons behind this trend? And do you see any risks that are being overlooked at the moment?
There's no doubt the propensity of these evergreen funds has sort of opened up this democratisation of private markets, which is a term I really don't like. I think that what we've seen at the moment, and where private markets have been a key part of our portfolios for a decade now, where it's right for the client and using a strict liquidity budget. And we're very conservative on the way we rate liquidity, as you know, it's a month or higher. I think the dangers that I see, especially on an Australian context, is the number of funds that have come to our market. We could waste every hour of every day seeing private equity or private market funds. And the disparity in quality is the big thing. And I do think there are going to be some accidents out there. And it's making sure that you're diversified within the structures that you hold, you're diversified within the asset classes, and that managers are delivering what they say they are. And I do think there are going to be some blow-ups. Yeah.
You also touched on the evolving perception of US sovereign risks. What was the mood in the room over in Europe at the conference regarding the future of the US dollar? And did any particular viewpoint stand out to you?
Talk about crowded trades. Everyone was short the US dollar and saw the US dollar going lower. I think one of the key things is the fact that the US president wants to see the US dollar lower. The US president wants to see lower interest rates. Lower interest rates, as it would therefore, especially when somewhere like Europe has already experienced lower interest rates, would therefore drive the US dollar lower. So everyone's getting on the back of the lower US dollar trade. And then piling into alternatives such as gold, even digital assets were being mentioned as alternatives. Yeah,
well, and just summing up, what was your biggest personal takeaway from the conference, and how do you think it should influence investment thinking in Australia?
I think the biggest thing for me was, and it wasn't just the conference, but was also seeing, I saw 14 wealth managers in London, and everyone was discussing the increase in the US risk premium. And so, yes, we're talking about lower US dollar, etc. But the US president is creating that US premium, and the fact that the US is being regarded as having higher risk. I think it is, though, interesting. Europe has done very well, and everyone seems to be behind a Europe trade. But it has a tailwind from infrastructure spending and defence spending, and defence stocks have already rallied very, very aggressively in Europe. But what do you invest in? And I sort of look at GDP growth. Yes, in the US and the UK they're going to be roughly the same this year, but then next year the US starts to pull out. And again, and I think you're going to see that in earnings, and it will probably be broader than what you've seen back 12 months ago when we had the Magnificent Seven really running. So yes, you've got a higher US risk premium, but I think at the end of the day, everyone's going to be heading back towards the US. So I think that's the key.
Well, thank you, Will. I think it just highlights the importance of getting offshore to these regions and getting a different perspective. So thank you for sharing your insights, and I hope you enjoyed listening.
Thanks, Kane.